Welcome everyone. In today's video I wanted to talk about Friktion Finance and how you can use it to generate high yields upon your crypto assets. So essentially what Friktion Finance does, it allows investors access to different option strategies. So for example, you'd be able to deposit your SOL into this covered call vault. They would take that SOL and then sell a covered call against it, and the premiums that they generate from selling that covered call they would return to stakers. So that's currently returning about 46% APY. Now these numbers will fluctuate over time, but we've also got 40% on MSOL, 193% on Saber, 84% on FTT, and 113% APY on your Luna. So if this sounds interesting to you, then definitely continue watching this video. But before I get any more into this video, just know that none of this video is financial advice. So now that I've got that out of the way, let's explain how Friktion Finance works. So if you're not familiar with how covered calls work, I will quickly go into it in this video and cover a few examples, but I recommend you watch a couple of videos just to get familiarized with what's going on, because once you understand how covered calls work and also how cash secured puts work, you'll be more confident in using Friktion Finance and you'll be more aware of the risks when actually depositing your precious money into Friktion and all of the other structured product protocols here on Solana as well. So Friktion Finance put out an excellent article on their Medium just talking about what covered calls are and giving a few examples. So I'll read this out, and I think it's quite good to see the example so you can know exactly what might happen. So what is a covered call and what makes it a good income strategy? So a covered call strategy involves generating passive yield from selling call options on an asset that you own, in this example, SOL. In exchange for earning the premium from the option buyer, the seller gives away the right to purchase the asset at agreed upon strike price. It's important to remember that the strategy doesn't utilize any leverage or any token emissions. So that's interesting to note, because a lot of the yield farming strategies out there right now, they will trend towards zero over time because they often use token emissions. Say for example you wanted to get yield on your SOL, but you wanted to use Saber to do so. So you're LPing in the Saber pools. So whatever the yield is, it will trend towards zero over time as more and more people start LPing in that pool. And it will trend towards zero over time because there simply aren't enough tokens to sustain that high APY. So covered calls is a sustainable way to generate yield, and in fact in traditional finance they call yield farming essentially just selling options, right? That's the original way of generating yield upon your assets. So let's jump into an example. So say SOL is currently $200 and you deposited one SOL into a covered call vault strategy, and it writes a call option at a strike price of $220, which expires in 1 week. When you do that, you are able to collect $10, which is 0.05 SOL, or 5% in premium. So when you sell an option, you receive premium in return. So in this first scenario, SOL price hasn't changed by the time of the expiry, and it's still at $200. So your P&L is 0.05 SOL, so you've earned 5%, right? In scenario 2, SOL price falls to $150 at expiry, so the call option expires worthless and you collect 0.05 SOL from selling that option. So your P&L here, they calculate to be 0.07 SOL. So you've earned 7% return on your SOL there. I mean, the price of SOL has actually gone down, so you've lost money in dollar terms, but you've still earned yield upon your SOL. And in scenario 3, SOL price at expiry is above the strike price, say $235. So you would have to deliver one SOL for $220, which is now equivalent to 0.94 SOL. And you also collect 0.05 SOL from selling the option. So your P&L here, you've actually lost 0.02 SOL. So that's 2%. But the value of your SOL actually went up by 18%. So technically, you didn't lose money in this scenario. But what you've lost here is opportunity cost. You lost all of the upside from $220 to $235 when the price of Sol rallied. So why would you use Friktion's covered call strategy to generate income? So you can enhance income with volatility. As volatility rises, so does the premiums and yields which can be generated on call overwriting strategies. So that is one thing to note, and one risk of actually using Friktion and all of the other structured products here on Solana is that the yields will fluctuate quite a bit, and it will fluctuate depending on the market conditions. Of course, like anything else, if we're in a strong bull market, selling covered calls is going to be more profitable than if you were selling covered calls in a strong bear market. So number 2, active management. Friktion's customized solution offers automated strike and expiry selection, position sizing, and target risk reward, so you're able to set and forget across epochs. So that's another important thing, right? You could do a lot of these strategies yourself. You can go to Psi options or Zeta markets and sell options, but if you're not super familiar with how they work, you're not super confident in being able to choose the right strike price, the right expiry, how large your position would be, it would just be easier to use Friktion Finance Vaults, and you pay a small fee in order to do so. The third point, you're able to earn yields that aren't reliant on token emissions programs. So like I said before, most of those token emission programs will trend towards zero over time. And efficient execution through on-chain order books and competitive market maker auctions. So they do use various different options protocols as well. So it's not just Zeta markets and Psi options. They use like one or two others that I think don't have public websites for like the average user. So that is another thing to note as well. So essentially what happens is that you would come to this vault, you'd press deposit, and then deposit however much Sol or however much Saber or however much Luna you would want into that particular vault. And you can see all of the information down here. So these vaults will have capacities. If they're full, you won't be able to deposit any more Sol into them, and that's because there is a certain size limit you can take when selling options. So they've capped it at 200,000 Sol, and you can see here the underlying asset is native Sol. The last traded option was a $175 strike price call expiring January 14th. So essentially what happens is if you're going to deposit into Friktion Finance, you have to do it at a certain time for you to actually start earning yield. So users can deposit assets anytime into whatever strategy they want, but they won't be deployed until 12 a.m. on a Friday. So deposits made during an active epoch are pending deposits until the next epoch begins. So an epoch is essentially just a week's time because all of these options that they're selling expire in a week. So at which time they are deployed into the strategy. So whilst you can deposit your assets at any time, it won't start earning yield until the next epoch starts. And so conversely, you're not able to withdraw your assets until the end of an epoch as well. And so they give reasons for this as well. So here under the safety part, the pending deposit and withdrawal is necessary because entering and exiting mid-epoch could be abused unfairly to dilute yields of other participants, or even worse, drain balances of other participants. Ribbon Finance, they did that. However, it led to unfair accounting attacks, and so Ribbon V2 ended up getting rid of instant withdrawals, and it's cool that Friktion Finance has taken that lesson on board and decided to not do that either. So that's one thing to note, and one risk of actually using Friktion Finance is that you are locked in for a week when you deposit your assets in there, and they actually are used to start generating yield. So if you want to stay liquid, say for example you are going to get margin called, but you have your collateral in a Friktion Finance vault, then that's less than ideal. If you want to stay liquid, if you got bills to pay, yada yada yada, then it probably doesn't make sense to use Friktion Finance. Another thing to note, and like a possible drawback of doing this, is that the actual returns are different from what you see here. So if we just hover over this here, so 0.84% is the 7-day yield, and when they extrapolate that yield out, you're getting 3.21% monthly, 38% on an annual basis, so this is if your stake is not compounded, 46% APY if it is compounded, and only 40% APY once you take into account fees. So That's one thing that you're going to have to take into account, is that these numbers aren't going to be exactly what you expect, and these numbers are going to fluctuate over time as well. Like they said before, it highly depends upon market conditions, and sometimes you're going to lose money as well, so definitely be aware of that. But there are other structured product protocols here on Solana as well that you should definitely try out. So we have Tap Finance, so they offer, you know, a similar service. You can get yield upon collateral. What's nice here is that you can use your Pi, put that to good use by selling cash secured puts on Bitcoin, currently giving you 20% APY. Katana as well, you're getting some pretty good yields here, 94% APY on Wrapped Luna. And lastly, Chest Finance, so again, good yields, 50% on Sol, 31% on MSOL, 27% on ETH, so that's pretty decent. So if we scroll down, we see here vault number 2. So this is called sustainable stables. So you're able to deposit stablecoins into these particular vaults, and what they do is they sell a cash secured put, and the premiums generated from selling that put are then returned to stakers. So you can sell a put on the Mango token for 34% APY, sell a put on Sol for 41% APY, and on Bitcoin, selling a put here is not very profitable. And in fact, I think it's probably not even worth actually doing this particular one, because it's a stable coin strategy and you don't have actual price exposure to Bitcoin itself, and you can get higher yields than 9% on your stablecoins right now, and you won't be locked in for a week. So I don't think it makes too much sense to go that low APY, but this is a nice option if you don't want exposure to any of these cryptos and you just want exposure to stablecoins and you want a stablecoin yield farm. You can go ahead and deposit your stables into any one of these vaults and earn, you know, up to 40% APY on your USDC. So thank you for watching. I hope you enjoyed this video and learned something new, and make sure to subscribe for more videos like this one.